Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:22 a.m. Central Time, and I'm recording this in preparation for Market Day, August the 17th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, just where are we this morning? Really, pretty much scratch. And as you see, all four of the U.S. broad market indices as of the time of this cut were about as scratch as you could possibly get in a random distribution. I mean, you just hardly could throw the dart and be more scratched than this. Now, crude oil is a departure from that. It's down about 1% and continues to just take a thrashing. Euro down about 0.25%, bonds up about little over 0.25%, and gold the same, a little over 0.25%. China's up about 0.75%. Hong Kong going the opposite direction, down about 0.75%. Japan up about 0.5%. Germany up about 1/3%, and United Kingdom, much like the U.S. markets, essentially flat. In terms of macroeconomic reports for this week, we've got a number of important reports, but for the next 2 days, we have housing coming up. Let's see, here it is. Housing Market Index. A lot of people will be paying attention to that, even though it's listed here as a yellow flag report. Empire State Manufacturing is also online for before the market. In terms of tomorrow, don't see. Oh yeah, building permits, housing starts. That's the one I was looking for. Here's orange flag report and red flag report related to the housing market. That one will certainly be watched. We have other important reports that will be coming out later this week. FOMC minutes is this week, so look forward to that later into the week. We'll get more detail on that tomorrow. In terms of our current volatility, really not much to get excited about here. Skews well below our cautionary level. IV percentiles continue to be all low, and they're all in the lower third. Standard deviation moves, we haven't had one in now 3 trading sessions, though we had a cluster there 3 out of 4 days with pretty significant moves. And even this day here, that is now 3 days out, it was actually a big moving day, but just ended up closing at much the same place as where it opened. So you know, the expectation is for an increase in volatility, but when that happens is hard to predict. In terms of our regular daily report, number of changes here for the beginning of this week. The top, pretty much the same here, though. Market trend, intermediate term, phase opinion. We're still calling this phase 2, but bottom line, we are as neutral as you can be. And while we will share some of the technical statuses of these things, we're really absolutely dead on neutral. We're in a historic period of neutrality. We've had more crosses of the 50-day moving average than ever before in 1 year, and we still have 21 weeks to go in this year. And we'll take a look. Let's take a quick look right now at the charts. We are in the middle of the range. We are in the middle of the coiling pattern. We had the false breakout just to come right back into the middle of the coiling pattern. Really, from a technical basis, little here to tell us which way it's going to break. Obviously, this one was rejected. If we were to break out to the top side, would it also be summarily rejected? But we're about to come to the apex, so it would seem that you know, that this would need to resolve itself sometime soon. And we do have the kinds of reports this week, whether it be the Fed minutes, and other reports that could be the incentive for a breakout action. You do also have the monthly expiration coming up this Friday, so a number of things that could kind of come into play here to finally generate some energy and have some direction here. In terms of some of the other indices, not quite so neutral, and indeed take a look at the Russell, which we normally look to be a tell to the lead, especially to turning points, and right now this just looks quite bearish. I suppose some might draw this as a wedge, and a wedge would be a continuation pattern to the bullish side actually, though normally you look for a wedge after a protracted kind of bullish period, then a wedge to kind of counter, and then continuation pattern. But this wedge here is after a protracted sideways period, so it looks to me frankly more as a rounding top or some sort of breakdown, but it really kind of depends on what time frame you're trading and what you're focused on. But certainly this does not look as strong as the S&P. In terms of the Nasdaq of course had this wild action driven by Google. It kind of broke above the range, but it's been broken back down into a consolidation pattern since then, and really is back into the old range, albeit near the top of that old range. So is it going to fall back into the prior range after the a couple 3 weeks of being out? But again, certainly not something that is terribly bullish at this time. And then the Dow, very much like the Russell, could be argued that we've got a descending channel or a wedge pattern of a type. But again, the primary thing here is just sideways consolidation in this kind of historic sideways move. Now, we've had death cross, and a lot of commentators talking about that. We've actually seen some data to where the follow-through on death cross is really quite questionable. But bottom line is that from a moving average standpoint, obviously never good when you have the 50-day crossing below the 200-day, and certainly that's just one of the things that's going on right now. Bonds, of course, have been, something of a relief bounce off of this bottoming pattern that we had for several weeks. And this could also, in addition to the Russell, be something that we'll watch to see just where we might go. In terms of our investor postures, IBD has it as uptrend under pressure, and then this is going, I think this is our 4th week now as uptrend under pressure. Accumulation distribution continues to be very ugly at D+ for both the S&P and Nasdaq. GMI index is a 3 out of 6, and I believe that author is sitting on cash right now, choosing to not participate in significant long positions, while this market is just flip-flopping back and forth. And you see the decision point scoreboards also an awful lot of red here, certainly not very friendly in terms of being in long positions. Our intermediate term market posture is actually first day bullish. We had a first day bullish earlier this last week, and that immediately was rejected. And you just see this kind of really neutral status. In terms of position sizing opinions, technically, they're coming in at up to 50% and the 75 to 100%. But really, I would suggest that you pay more attention to the totality of this at this point. Market posture, again, is first day bullish, and you see just barely over 50. Dow also bullish at 28.7. Nasdaq a little below 50, so a much weaker bull. And then the Russell finally came out of that lower reversal area where it was severely bearish and is now turned also bullish. So all 4 of these have turned as bullish, but really, frankly, could not be more neutral than they are in many of these cases. Overall hedge warning status, we remain as threshold level 1. We do have a number of the volatility-based areas that improved, and actually this should not be in red anymore. They went to okay on cross relationship and the short versus the intermediate term relationships. We do still have a VIX daily squeeze, so that certainly says that we should expect increasing volatility at some point. And the other disturbing area is this distribution day count continues to be so very high. S&P at an 8. New York Stock Exchange, new high, new low. Nothing of note there. We do still note that these intermarket risk aversion indicators are all still flagging as what we call risk offs. They're really tightly wrapped. Some of these you could call that look like they may be starting to roll back up, but really very all weakly structured, and certainly are not calling for any kind of strong risk on kind of performance. In terms of special opinions, option income strategies, the VIX is inside the acceptable window. Be sure to consider that that daily squeeze is present and that we have the opportunity for increased volatility. And you certainly have some of the reports this week that could give you that. In terms of covered calls, there is some changes here. Conditions are borderline to initiate new positions for novice traders. Aggressive traders should consider only in the money strikes or a reduction in position size. So that is also taking a more conservative stance, even for the aggressive traders, that instead of using the typical, for us, typical kind of split between in the money and out of the money, this is calling now for just in the money strike. So very, very conservative stance on covered calls. Also consider legging into your covered calls through put selling. Sell those puts, take that premium in. If you should get to the point where it's assigned, accept the assignment and then roll into the covered call strategy. So very conservative stance here to the covered call strategies given the current market conditions. Put selling conditions also borderline acceptable for new core put positions. Consider reduced position size or look for that bottoming pattern to form. In this case, especially that you have a breakout of that coiling pattern that we just talked about on the SPX chart to the long side. Unfortunately, while this might be acceptable for put selling, especially if you're selling puts on positions that you're willing to own and the position size that you're willing to own, and these are something that's being sold with less than 30 days time. If we get a run up to the top of that range in the SPX, you might consider taking whatever profit targets you might have. And that kind of goes to the point of being in this market, considering at least scaling out of some of your profits or taking profits when you get to technical areas of significant resistance, and not being as patient perhaps to hit your usual targets as you might in a more bullish market stance. Aggressive traders should consider scaling into positions as well. So very, very, very almost a bear market kind of consideration in these opinions here, all very much flavored with a very, very conservative stance at this time. And in terms of relative rotation graph, you see here FDN, which is the Internet Index, ITB, home construction. Those two certainly are looking positive and going in the right directions, into the right quadrants and so forth, but most of the rest of these sectors are all looking very messy. Or I mean, look at XBI, up and then all the way back down into this lower right quadrant. So there's just not an awful lot of consistent follow through, and if you'll follow the patterns here, I mean FDN's also been wiggling back and forth. There's not an awful lot of consistency here in these sectors, and it's very hard to justify positions, and you can see why our friends at the GMI index were kind of taking the stance of going to all cash, and you could see why also some of these opinions, such as covered calls, are going with such a conservative stance when you take a look at things like this relative rotation graph and where there's just such poor consistency and follow through. In terms of sector market posture, again, very much wrapped around neutral moving average type lines, but utilities certainly have been of note of late. And on the flip side, materials, have been very consistently weak. Something to kind of keep in mind there. Had a pretty decent 1 day for Friday and the 1 week outlook. And if you're talking about utilities, perhaps one of the more consistent performances, it took quite a pullback earlier in the year after being the hero sector last year, but seems to be finding its footing again. And especially as there's so much poor return and poor follow through. You see here's XLU. It certainly seems to be getting improving, as it says in this quadrant here. And that certainly seems to be bearing out in what we see across this percent change spread here. So that's probably enough for today. As always, we greatly appreciate your retweeting us to your Twitter followers, StockTwit followers, etc. YouTube, liking us there, subscribing to the YouTube channel that we have set up for you to find these videos easily each day as they are posted. And of course, other feedback can be sent to support at falconglobaltraders.com. Always most welcome. More information about what we do and how we apply these principles can be found at this website. Disclaimers as always. Hit the pause button if you need more time to review this. And we'll see you back here tomorrow morning for the market preview from Falcon Global.